Hey everyone, Jake here. So in my last video, I went over 8 different ways you should consider using your money once you've been paid. Spoiler alert, number 8 is investing. Now, investing is fantastic, but when you realize a gain, like sell a stock or something, you're actually subject to capital gains tax, the amount of which can kind of differ on some factors. Now, one thing is certain in life, me asking you to smash the like button for the YouTube algorithm, and taxes. But what if there were no taxes? What if you made a $50 gain and you just got to keep all of it? This is all possible with a Roth IRA or a TFSA. Let's get into it. A Roth IRA is a specific type of individual retirement account which is available within the United States. And the TFSA is a tax-free savings account, and that's available in Canada. For both of these accounts, you don't actually have to pay taxes on any money you invest or any of the gains from it, or when you withdraw money. So that's potentially saving up to like 40% on a gain of an investment, which can be a lot of money. So you can get a Roth IRA or a TFSA at most financial establishments. Again, a TFSA is in Canada and a Roth IRA is in the United States. For me, I have a TFSA with both Questrade and Wealthsimple, which are both online platforms. So these accounts can be used as investment accounts. So you can buy stocks, bonds, ETFs, or just hold the money as cash. So an important part of these accounts is that you're actually limited on how much you can contribute to these accounts per year. The total amount that you can contribute may actually change from year to year. Let's go over some of the specifics to a Roth IRA first. So in order to contribute to a Roth IRA, you actually require some sort of earned income. So again, the amount you can contribute differs from year to year, but in 2021, it's weird it's 2021 already, but in 2021, the total is $6,000 for a Roth IRA. If you're over 50 years old, it's actually $7,000. One thing that's kind of noteworthy is that you can't actually contribute to a Roth IRA if you're single and your earned income is over $140,000 per year. Or if you're married and then your total income is over $208,000 per year. So withdrawals are tax-free for a Roth IRA, and earnings can only be withdrawn penalty and tax-free if at least 5 years have elapsed since the initial deposit. It's also very much worth noting that earnings can only actually be withdrawn after the age of 59 and a half. If you do decide to withdraw some earnings before you're 59 and a half, then you may actually be subject to up to a 10% withdrawal penalty. One kind of unique way to kind of get around the income limit or the income limiting factor for a Roth IRA, in that if you make over $140,000 a year, you can't contribute to one, is something called a Roth IRA conversion. So what this actually allows you to do is take a tax-deferred account, like a 401k, and roll over funds from that into a Roth IRA. So an example would be, say you had $10,000 within a 401k, you could roll that $10,000 over into the Roth IRA, regardless of your income. The one caveat there is that you're going to then have to pay taxes because you are moving it from a tax-deferred account to an after-tax account. So you would then have to pay taxes on the $10,000 as income. One thing that's kind of cool with this though is that you could do this with an unlimited amount of money, technically. So once you do this, any growth you would see, again because it's within a Roth IRA, is then tax-free. So let's go into a TFSA now. So if you live in Canada. So one of the nice things with the TFSA is that the amount that you're actually allowed to contribute rolls over year to year. So if you were 18 in 2009, the total amount of money that you're allowed to invest into your TFSA or contribute towards your TFSA is actually $75,500 as of 2021. So anytime you fail to contribute the maximum contribution for a given year, any remaining money that you didn't contribute will then be added to the next year. So in a way, the amount that you're allowed to contribute is kind of always expanding. If you accidentally over-contribute to your TFSA, you are subject to a 1% penalty, which is a monthly penalty, on any of that over-contribution, until it's withdrawn at least. So one of the really nice things with a TFSA is there's pretty well no limit on the withdrawals. So that means that you can withdraw any amount of money you'd like to from your TFSA at any time. There's no age limit or anything like that, like there is with a Roth IRA. The one important thing though, because there is a limit to how much you can contribute to the account, is it does actually affect how much you can contribute the following year. For a TFSA, the amount you actually withdraw is then added to the total contribution that you're allowed the next year. As an example, say I withdrew $3,000 in 2020 from my TFSA. Now, in 2021, the limit is currently $6,000. However, because I withdrew $3,000 last year, that would then be added on to my $6,000 limit within 2021, which would mean that I could contribute $9,000 in 2021 to my TFSA. One thing that's important to note for both a Roth IRA and a TFSA is that even though you're going to be investing in stocks and ETFs and stuff like that, is that you shouldn't be using them for day trading. The main reason you don't want to use them for day trading is because day trading is actually considered a type of business. And both a Roth IRA and a TFSA are both a personal account. And business and personal in the government's eyes are two different things. So do you have a Roth IRA or a TFSA already? If so, what do you use it for? Leave a comment down below. I'd love to hear. I personally think that it's a great way to just help make some tax-free capital gains and just grow your wealth over time. If you like this video, please feel free to like and subscribe. I post a new video every Wednesday, so I hope to see you next time. Cheers.